in the money. Okay, that's fair enough. There's some discussion of it in the blueprint. There's some discussion in the lessons on Fusion, but let's take a look at an example. Okay, I'll do it this way. This isn't going to be the best one, but no, I'll do it this way. You don't have to give me your specific one. I'm just going to use an example. Ali today, which is one of mine. See, my cost base is about 77.80 total for the stock, holding the 85 put for January. And I paid about 410 for them, maybe a little bit higher than 410. Yeah, it's about 490. Okay, so now this is a position I've been managing and it is bulletproof. So let's say that regardless of where you are, you're in this current position. What you did is you did income method number 6, a bear call against it. So let's say I would have sold the 90 call and bought the 95 a few weeks ago. And let's say we sold this for 110. So I was selling the 90, just as I would if the stock was trading at 88 or 89, instead of just selling the call and capping the upside. Income method number 6, the bear call. We buy the additional outside strike. That's probably 35 cents, but that's okay. And we receive a net credit. And here's about 75 cents of net credit for this position. And we give ourselves a little beat here. Now this is similar to what Gilliam's asking here regarding management of this income method number 6, where the short call is now in the money and the long call is not. Now this is at expiration here, so this isn't going out to October. Ali does not offer weekly options, so we're just going to have to use the standard expiration. But let's say this was my scenario, or even if it expired next week. If it did have weeklies and this was next week's, and I'm concerned now because I bought a 95, we sold the 90, and here we are, right smack dab in the middle of the two. If the stock stays at this price, which is probably Gilliam's fear, this call expires worthless, we get no value back, and now I've got to spend $275, $280, which I had to do today is about $285 to buy to close my 90 call. I rolled up to the October 95. But that was just a simple call, wasn't income method number 6. Okay, so what would you consider doing in this situation? Well, got a couple of answers for you. And some of these answers are going to relate to exactly what we covered on Wednesday and posted in the archive on the 8 ways to manage a bull put credit spread. Rather than considering this as a married put structure, what's hurting you right now? Well, maybe the long put because the stock's going up more than you expected. What's hurting you is this short call, really, in this combination. Okay? So number 1, I don't know your strikes, Gilliam, but here's one thing to consider. Number 1, close the spread. Okay? If you think the stock's going to continue up, I might leave it open to try to get some of this, but if you want to just close the spread, let it run, and then do this later, that's an opportunity. So this sounds really annoying, doesn't it? This one here, just closing the spread, taking a slight loss on it, and then leaving it open, expecting the stock to go up. Well, what happens if it comes down? Well, could have left the spread open. This is an option. I'm not saying it's the best option, but it's an idea. Buy to close your short, sell to close your long, get out of that part of this trade with a small loss. If you think it's still going to continue up, let it run a little bit more, do it again. Honestly, I wouldn't do that. I don't know your position even, but in this situation, I wouldn't do that. I'm throwing it out there as an opportunity. Number 2, I mentioned I don't know your strikes. Okay, so here, I sold the 90 and I bought the 95 in our theoretical trade. The stock's at 92.75. What I may consider doing is rolling the short up 1. Okay, so you're going to roll the short up 1. It's an income method number 2, essentially. Think of it just as short call, income method number 1. You're just rolling it up, but you're not touching your long. Okay, rolling the short up. I can't do this on Ali. Ali doesn't offer 2.5 point strikes. I would buy to close my 90, sell to open a 92.5 to give it more room. It would be done at a debit, but I'd be okay with that because I'm getting 2.5 points higher on the stock. This would adjust slightly as far as the risk reward goes, but I'm taking away that net credit. Okay? So, but rolling the short up 1 strike if you have 2 strikes between. If you don't, you can't do this. Okay, so what you would do in that case is close both and then move it up, just like a bear call spread. I sold in 90.95. My stock went to 92.75 between the two strikes. What's one way to manage just a credit spread? Liquidate the spread, roll out further in time, and maybe sell at 95.100, maybe a 97.5, 102.5 if they're available, and so forth. Okay, so you close both and you roll the whole spread out. Okay. Don't know your position, but what you'd have to analyze now for number 4 is what is the cost to do this, and what are your expectations? If you're still bullish and you've still got 2 to 3 weeks to go and you think the stock's going to run up, maybe buy to close the short only. Now this is going to add debit back into the position. It's going to either increase the risk you have or lower your bulletproof status, your guaranteed return in this case. But just buy to close the short. You're going to be paying $320, $330 in this case, for example. If this was an October series or a couple weeks out, it'd probably be around $310, $320. But leave the long. And then if the stock continues to go up, yes, you've increased your cost basis. Yes, you've increased sort of your risk. But if it does keep going up, you're gaining positive delta on the stock and this long call. Not the best of ideas, but if you're really bullish, you think it's still going to continue to run against you, let it go. Number 5. If I had a 97.5 in this case, I might consider it. I don't. If I was at the 92.5, 95 spread right now and the stock was here, or if it was at 93, where it was earlier today, even 94 at one point during the trading day. Number 5, roll the short above the long. Buy to close your 90, sell to open a 97.5. It's going to be done at a debit, but what would happen in this case? You now sort of have a bull call debit spread, don't you? On a stock that's moving up. You've got a 95, 97.5 bull call spread where you can get an extra 2.5 points back if it's above 97.5. Extreme example here because we're still 5 points away from it. And of course, you still have an upside potential because your short now is at 97.5, not 92.5. It wouldn't work here. It wouldn't look good with these numbers because that's too far of a move. But again, if I was at, say, the 92.5, 95, my stock was at 94, 93, which it essentially is, I may consider buying to close the 92.5 and selling to open at 97.5. Same month. I'm not moving the long. Okay, I'm just swinging this out to a higher strike. Now, what do we know about the income methods? Well, that would create a bull call debit spread on top of the married put. It's double bullish and I can get an extra 2.5 points back. But there's also an income method where I can get more, right? Income method number 5 is the ratio spread where I sell 2 out of the money calls and buy 1 in the money. Well, I still wouldn't be at a credit, but I could potentially buy to close this and sell to open 297.5. So I've now got an income method number 5 position in play where I can get an extra 250 back on the debit spread, and I helped fund that by selling 2 calls. Second one's covering the stock, so it gives us that capped gain in that scenario. But rolling the short up to create the debit spread and maybe selling 2 times as many to do that. As I mentioned, this wouldn't work, but let's look at that structure very quickly. Here we go. Okay. So it's not going to work here because I don't have the right numbers. Again, if I was in a 92.5, I'd consider rolling to the 97.5 to create the debit spread. Rolling right now from the 90 to the 90, I can't even go to the 97. I have to go to 100 because it's a 5-point spread, so it won't work. It's not going to look attractive. But there's our position. So all I'm going to do now, and I'm all at intrinsic because of this expiration, we're going to buy to close the 90 first. Okay, so what would that look like? Remember, we added about another $3 back into the position, $320 back into the position. You've got a married put with a long. That was one of the ones I talked about, buying to close the short, leaving the long call open and the stock to run, but you're going to take away from your bulletproof status or add to your overall risk. It's okay, but if it works out. But that's the idea. If it reverses and comes back down, we, of course, we're better leaving it alone, not making an adjustment. We don't know that. Now, I'm saying in September, I got to sell the hundreds, but let me grab a price from October. At 100, 65.85. All right, so let's sell 2 at 50, right? So I'm going to sell twice as many calls at 50. All right, so let's go ahead and do that. And my risk is going to be wrong. Oh, no, my risk worked out well. Okay, so now you've got an income method number 5. You canceled that 90 obligation. You've opened it up to 100. So if the stock is trading at 100, if it keeps going up, wherever your expiration is, you get the 5 points from the bull call debit spread, 95 to 100. You have the extra short call, which is covered by your stocks. You have no margin requirement. Okay, and if the stock keeps going up, you start to give up a little bit, but you've increased your profit here. That's a large move, and you're up at the peak. All right, so those are sort of the 5 or 6 ways I might consider managing income method number 6. Another alternative, check your blueprint. Okay, let's go back to square one. If it stays between, and I almost did this with Ollie today, even though I didn't have an income method number 6, I just had the 1. If it stays between, you can let your stock get assigned for a profit. You'd have a profit from when you purchased it. You still have a long put. You're holding this long call too. Well, no, it would have expired at that point. So you get, I'm sorry, this would have expired. You get assigned. You make a profit. You have the long put remaining. Take a look at income method number 7 in your blueprint about getting back into the position. You might want to sell that. I apologize. You might want to sell the 90, 92.5, maybe even the 95 put near term for October against the January put option. Okay, or you might not. All right, that's income method number 7. You may choose to do that. You may not. You're sort of creating a calendar spread to potentially get back in the position if you're assigned on a short call and you're out of the stock and find yourself left with a long put. That's income method number 7. It can be used other ways as well, which we talk about in the blueprint, and I won't go into it now. Okay, and then you follow up, are all those management options described in the blueprint? Not all of them, but I know there is a members-only webinar somewhere I'll have to find for you. I know Kurt did one, the 5 ways to manage income method number 5, which is not what we're talking about. There's another one that discusses the management of income method number 6. That's a members-only webinar for blueprint owners, and I will track that down and get that to you. And if I don't like it, if I don't think it supplies all of the information that you require that we just discussed right now, then do a new webinar for members only. Ways to manage income method number 6. Okay, so I'll get that to you sometime Monday if I don't get to it this weekend. And anyone who's online is a Blueprint owner or Fusion subscriber, you'll see that information as well. Okay, so that's what we look at with income method number 6. And sometimes to me it is easier to remove this out. I mean, I love the graph of the married put, and I keep saying with the married put with income method number 6, if it keeps going up, I'm looking really good. I want it to keep going up, especially above that long strike, because it doesn't have a capped gain like you would if you just sold a call against the married put. But sometimes when I consider analyzing a 6 or a 5, I look at just the 6 and the 5, and I look at this and I say, what is causing me a problem here? Okay, well, the stock is up above this, which is my pivot point, so what would I look to do to get out of trouble here now that the stock is above my pivot point, my obligation? Well, I'd close it, the short, I'd roll it up. I might roll it above if my sentiment's changed and now I'm bullish. Might just get out of the whole thing or move the whole spread up a little bit if I can get the right premium by not going too far out in time. We talked about that a little bit last week and on the webinar on Wednesday with managing a bull put credit spread. That sometimes when the bull put goes against you, and we're in a different structure because this isn't a married put and I still have unlimited upside, but if I simply just say, oh, well, let me buy back my 90 and 95 and let me pay $3 or so to close that 90, 95, $2.20, let's say, to close that, and we kept the 75 cents. So I'm down about $1.50, and I want to sell the 95 and buy the 100 to keep that structure going. Well, I have to go far enough out in time to where this is a net credit of at least $1.10 to cover it. That might take me out to December, to January, maybe further in order to get that net credit. So a lot of times just moving the spread out and up comes with the flaw that if you need to roll for a credit, or you want to roll for a credit, instead of going 2 weeks out, 4 weeks out, 1 month out, you may find yourself 3 months out, 4 months out or more. Let's just look at this January real quick. Yeah, so this would easily do it. You know, worst case scenario, 80 cents bid-ask spread here, so I get about 580 to 380. Yes, it's about a $2 net credit. December and November aren't available yet. I could have waited till after September expiration, after Friday. Monday, those new options will be released, and we could look at it then, but in this case, oh, there. Okay. All right, Larry says, will you be discussing long-term positions using protection and putting money to work in a market that has gone up for 9 years? Leap trades, for lack of a better term, in the moment. Well, I can discuss anything you want, Larry. I don't have any planned material. This is all questions coming in, okay? So I do not have the time on the open discussion session to do really what you want, and here's why. You want me to comment and look at the aspects, and I think you're even asking me about what your expectations would be if you did calendar leap spreads of some structure over the past 9 years. Okay, I can't do that in an hour. I can't do that in 20 minutes. I can't do that in 2 hours. I've got to run tests. I've got to come up with what I think would have been a good search for an extended period of time for calendar calls, which you'd be focusing on since you're bullish over the last 9 years, 8 years, okay? And then I'd have to get those results. Then I'd have to analyze those results and say, could I have done better, and tweak the criteria and do that and come up with something, okay? So what I can tell you is that in the diagonal calendar, in all strategies, Larry, we've put together the criteria that we feel is good for the strategy involved. Okay, so I've got calendar leaps number 1. I don't use the compound stock earnings for 1. The initial values is usually where I might start for a diagonal spread, but this might not match your goals. Hence why we've put this in initial closer in time we did during a webinar a few weeks ago. So diagonal spread, what is it? I'm going to buy an option that's far out in time, not even necessarily a leap. That doesn't seem to be popular anymore, Larry, just to let you know. I'm not saying leap trading is a bad idea. I'm saying most investors I talk to who are doing diagonal calendar spreads are buying 2 to 4 months out in time at the most and selling weekly against it. The traditional classic way of buying a leap option that's 1 or 2 years out in time and then selling month by month against it, I think investors have felt that there's been too many ups and downs in the short term. Long term, yes, it's still bullish, but they don't want to be subjected to that. So they're using shorter term trades, trying to increase their annualized premium, because if you sell week by week or 2 weeks, you get a much better annualized income in than selling month by month by month or selling 4 months out. Okay. Here you see, I just pulled this up, PZZA on the chart, because here you see it's one of two things. If we were doing this long term, okay, we could take advantage. I mean, we wouldn't notice these little hiccups here. But if you're doing this as a weekly spread, you bought an option 3 months out. Let's say here you bought an option 3 months out and you're selling weeklies against it. Here you're getting slaughtered. And then you're coming back up, but you got to make sure you didn't sell here, because then you have to roll it, and then you have to roll it again, and you're up here. But now you're near the expiration of the long call. Okay? So that's a tricky stock to look at with the shorter term strategy. Longer term, something like this would have been preferential, would have been, I'll just go 5 years, okay? You would have had a very good return. Let's say 5 years ago you bought a 2-year out leap, sold calls against it, got a little bubble. You probably would have been at a loss here in the first year. This would have been a loss. Even though you wrote all this time against it, once you got to here, that would have been a loss. Then you would have seen good returns with some hiccups. Here, you would have had to buy another 2-year out leap somewhere in there. So here you might look at your loss, but you would have made it back. And this is one example that's a bad one. But then down here, over the last 5 years, I think a calendar diagonal spread of buying a 1 year or 2 year out leap and then buying it once every year to extend it, when you got within 70 days to buy another 300 days out in time, I think you would have lost on this one. This isn't common. We know what happened. But sure, you take a look at Netflix over the last 5 years. Something along those lines to save money using a diagonal. You would have been break even for about the first 2 years, year and a half. Then you would have started making profits. Then you would have had a drag period, more profit, more profit, more profit, huge profit. But now here's the catch, isn't it? On a diagonal spread, you're probably selling here, and then you've got to roll it, and then you've got to roll it. At one point, here in the beginning of 2017, middle of 2017, you should have just treated whatever you had left as a long call and not sold calls against it until February 5th and 9th when we started the decline. Okay? It's tough. It's tough. But I can't go too deep into your question simply because I have the data that I trade with the diagonal spreads. I traded diagonal spreads using leaps in the past, but I haven't done that in probably 4 years. Use a shorter term, 4 months, 5 months out of time, not using a leap option. To answer your question with any type of good or bad idea, I can do one thing for you real quick. I can change accounts, and we'll of course talk about it later on a coaching session or things of that nature. For very long-term growth, I prefer to use the radioactive married put. More capital intensive, but I'm only risking single digits of what I invest. My put's usually out an average 7 to 8 months out in time in that technique. So I've got a long-term play. And I'm protected in the worst case scenario. Remember, what's the problem with diagonal spreads? Let's find a good price one. Oh, the shorter term ones, by the way, usually find lower price stocks. Longer term, you usually see higher price stocks. I'm going to do, good idea. Great idea. I'm going to do one thing very quickly. Larry, follow me on this. I'm going to take our calendar leaps #1 screen. I'm going to look over the results. I haven't looked at this in a while. And I'm going to put in some criteria that I use. Earnings, good. PE ratio, good. I need some more stuff in the technicals, okay? I know I want a delta of 6. I definitely want a delta ratio of 1.8. Debit to strike difference ratio should be less than 1. I need that to be less than 1, okay? Yeah. Debit to strike difference ratio. Yep, I need that to be less than 1. Now, on to the technicals. So I'm taking my calendar leaps #1 default, and let's put this to 40 days out in time for the short. That's our structure. But I'm going 250 to 650 days out in time. Anything that's almost a year out in time or more. But technicals, I want a stock to be in an uptrend, as I would with a bull call debit, bull put credit. And I want to see something that has at least a positive MACD crossover for the past few days. And I'm just going to leave it at that. All right? Wow, Carnival. I keep seeing that one. I should have done that as a married put a month ago, but there's still time for me to do it. Always an interesting one. All right, so I have some results. That's good. And yeah, leaps. There you go, 2020. Okay, pretty far out in time. So let's call this leaps with short-term look. Okay? I know that's a confusing title. I'm just throwing something together. Now, let's take some time. This might take some time to load. And where's my friend there? Mike S., I see your question. I'm going to be right there in a moment. Okay? All right. Okay. And all right, just looking at some things. Good, good. Okay, so I see Guillaume's question, and Larry, I see your follow-up question. And Larry, your follow-up is, in this situation, more going forward than looking back. That's a judgment call. I can tell you that I'll still trade diagonal spreads the way that I trade them with 15% of my portfolio, as I have been for months, years, 2 years, 2.5 years now, with that structure and other things in my portfolio. But when I see the market start to turn, I'm either going to switch to calendar puts or stop doing diagonal spreads and bull puts. As simple as that. Okay? If I feel that we've taken the downturn, I feel that we're in a correction mode, I will do that. Don't think we're necessarily there now, but if I start seeing more indicators that point to that direction, you always want to change strategy. I'm not going to stick only married puts. Married puts, radioactive trades are the only thing I would stick with in any market condition in my portfolio. I've got to back out of the other ones when the market changes. Well, except for maybe strangles and straddles, but that's a different story. All right, so why did I save this search? Here's our leaps with short-term look. So this is leaps, but using shorter-term, under 40-day calls against them. I'm going to go back test. Now with this, I can only go back 3 months. It's perfectly fine. I'm going to go to Smart History. On the trial, you have access to 3 months worth of back testing. Let's go back as far as we can. July 23rd, right? All right, so on July 23rd, let's run that leaps with short-term look. This might take a minute because we're downloading all the history now that the market's closed, compiling all the numbers in the history database so we can access trades even as of close of today in the history. I do apologize. We end up doing the history maybe once or twice during a Friday webinar, and that's there. While we're waiting for the results to come in, Gilliam, I'll answer your question. The membership where you can see my radioactive trades and Ernie's radioactive trades is the Fusion subscription at radioactivetrading.com. It's not found in Power Options. Okay, and you say, how many trades and what frequency do you typically offer? It's maybe 1 to 2 new trades per month between the 3 portfolios, and as many as maybe 3 or 4 income methods for each of us, 3 or 4 adjustments inside those trades each month. Okay. All right. So that's what I'm looking at here. Now, where am I going with this that we just did here for Larry? And Mike, I'll get to your comment in just a moment. These are the trades that would have matched that short-term trade, would have sold August 31st calls on some of these, buying out in time June, January 2020, June 2019, and more. I'm just going to take the first page. Let me change it. I'm going to change this to 1 result per security so we don't get duplicates as we saw of Starbucks and Comcast as well as Abercrombie. Good. Okay, 52 results. We're only looking at the top 15. This is going to take a while too, so let me calculate group results. What the historical tool is doing now is taking all of those positions that I entered that came up on my search, and it's calculating how well they would have done between now and expiration. This is going to take a lot longer because we're compiling the entire database in the background. While we're doing that, oh, there they are. Let's take a look at what we've got here. All right. Not good. Huge loss here. So when we opened the ANF position, Abercrombie, oh, we had earnings. It was at 26, and now the stock's at 21, and that was enough to cause our initial net debit of $8.37. Our long call now is only worth $5. So we've lost $3.37 or 40% of the initial net debit on that position. 40% loss is probably going to wipe out 5 or 6 previous gains. In fact, you see we're right only 40% of the time would have lost minus 3.8%. Now, of course, the idea is to keep managing them. That's why you're buying long term. That's why you're controlled. But just remember, you're still using a leap. And even though a leap reacts slower, a 10% drop in the stock price in the first 1, 2, or 3 cycles, let's say first 1 month to 4 months out in time, is going to cause your long call, which is leverage, to be down 30, 40, maybe even 50%. If you're closer in to, say, January 2019 instead of 2020, a 10% drop will probably show a 40% loss. You'll probably see closer to a 30, 35% loss with a 10% drop if you're out to 2020. But it's still leverage. It's still going to be 3 to 1 or 4 to 1. Okay? And we've got the capped gain here. So, you know, these two look good, but we're only right 4 out of 10. We continue to write this one, this one, this one, and this one. We might have to cut bait on this one that's already 20% loss, and this one, which is a 40% loss, because if we take any more, we're wiping out previous trades. So why did I do that? Let's see, July 23rd. And I'm going to take the initial closer in time very quickly. Different stocks, notice. Same date, July 23rd, but now we're seeing Pepsi, Wells Fargo, Morgan Stanley, Big Lots, much different companies than we saw in the first list. which was the leap search. Here's shorter in, where our longest time frame is at 120. Yeah, 60 to 120 days for the long. Up to 30 days for the short, but it could include weeklies. The other one could have as well. All right, so we're going to calculate this. All right, and I know, Mike, you're being patient. I'm going to answer Gilliam's follow-up question first, because it's really quick to answer. Once we see these results, I'm going to answer that first, Mike, and I'm going to jump right into your question, okay? Because your question is going to take some time for me to answer and make sure I answer correctly without giving you false advice. And I don't want to say false advice. That's a poor term on my part. But without giving you false direction, I should say. All right, so here, okay, we reversed it. We're right 60% of the time, but we still have an average of a 3.6% loss. That's not good. What hurt us the most? 45% loss here and 36.5. It looks, oh, okay. I only would have traded one of these, not three of these. So I'll take the big one to be nice. I didn't have the one result per security in there. Let me just refresh that. I'm really sorry. This will just take a second. So 40% success rate with the leap search. Not saying it's the best leap search. And we saw a loss of 3.8%. Let me narrow this down. There we go. So we only have one MS in there and one Pepsi. I know I'm going to take a loss on it. I'm not trying to cheat. I just wouldn't open 3 diagonal spreads on the same day on the same stock. That doesn't make any sense. I'd pick which one I think was the best and then maybe trade more contracts of it rather than doing 3 or 4 there. So let's just run this real quick. There we go. Good. Came in like lightning this time, respectively. 75% success rate with a 2.9% return, average. One big loss. We knew it was coming. It was on MS. And so there we go. That we've got 11%, 20, 16, some small gains, one small loss, one big loss. But not a bad cycle there for that time frame. It would have ended in August, on July 23rd, I'm sorry, yeah. So we were sold the August, they would have expired then on the 17th, so it would have been about 45 days in. So no, I'm sorry folks, 25 days in, 2.9% return, factoring in the 2 losses which we would have managed and kept going. And we'd probably still be rolling some of these as well. I just wanted to show you that, Larry, as a bird's eye view. I'm not going to say it's going to affect every structure that way. What do I mean? I just wanted to show you in the shortest term right now, we just look back a month or 2 months ago, 3 months ago, if I had opened positions that had a long leap option 3 months in, where would I be? We only saw a 40% success rate with a loss of about 3.8%, was it? Going shorter term, I see a 75% success rate, 2.9%. But of course, you have 600 days, 500 days, 480 days on some of those leaps. So you're going to continue to write and manage them. I understand that. I was just trying to give you a bird's eye view of one versus the other and why I think most investors have moved away from the classic buying a leap call and selling near-term calls against it. It seems people are going shorter term because the market is up and down. Since February, we've been going kind of up and down and up and down. And rather than take a risk with something that's far out in time, not knowing what's coming, investors seem to be playing diagonal spreads shorter term, 3 months or 4 months out on the long where they can still get out of quickly and not worrying about having a high debit and trying to collect on that if the market corrects sometime in the next 4 months. Don't know what's going to happen. Could it be poor earnings cycles? Could it be poor earnings expectations going forward that causes it? Could it be the event effect, of the midterms? I don't know. And it might not happen. I'm just saying I think that's why investors over the past 5 months to almost a year, plus the availability of the weekly options. You know, you buy 2 months out and you sell weeklies against it, you've got 8 write cycles in a 2-month period almost. That seems very appealing to some investors, okay? That's another reason why. Gilliam's question, then right to Mike. All right, so Gilliam says simply that I've been playing around with the married put search, which is based on the radioactive criteria discussed in the blueprint. I noticed that there are no ETFs shown, at least in the few. Do you sometimes show or purpose trades including ETFs? Yes, but see, there's something to remember here. The radioactive trading techniques are based on our criteria that has worked well for us, was worked well for Kurt, for 12 or 15 years, and I've been trading this for about 10 years now, 11 actually. And, we don't want to go more than 20% in the money. I want to keep my risk between about 3.5% to 8%, maybe 3 to 8%. I'll comment on that in a moment, Gillian. I keep that no matter what I do. Now, yes, we're looking specifically at a certain stock list here. So the ETFs are removed. Why? Because we want stocks that show growth potential of 5, 10, 15% over the next 3, 4, or 5 months. An ETF can have that, and we've seen that. We've also seen them fall more, but normally they're much slower. The two things that hurt you if you just try to change that list and search for indexes and ETFs is, number one, it's the risk. Sounds strange, but it is the risk. Combined with this, I typically don't want to go more than 2 strikes in the money. On a low volatile ETF, say trading at 200, 1 strike in the money, the 205, is probably only going to have a risk of 1.5%. Although it's 1 strike in the money, it's filtered out. 2 strikes might only be 2.8% because of lower volatility. It's filtered out because of that lower range. So if you want to look for ETFs, you want to take that out. Don't let the risk go above 8%. Let's go to technicals. Got to take this out. Most standard ETFs would not have that in there. That's the volatility, above 25%. Most standard ETFs won't have that. You got to drop this down to 0.05 or maybe 0.10 or not use a volatility at all. Now, how I'd look for indexes at this point? Okay, I still want it to be above the 50-day moving average. Fundamentals, I'm going to increase the stock price to say 400. Oh, sorry, folks. That's personal. I'm just putting it in there because the ETFs can't have the growth in there. We look for stocks with good earnings per share growth. ETFs don't have an earnings. They don't have an earnings per share growth. You've got to take that out. Okay. So again, you've got to lower the maximum risk because you're going to be a smaller range. You can leave just about everything else. You can even take it up to 8, but you'll never see something in this range with an 8% risk on a standard ETF, not 2x or 3x. Technicals, you've got to lower the volatility or take it out completely. Okay. Fundamentals, take out the earnings per share growth. Now lists, can't use this list. Let me just go indexes and ETFs. But I'm going to do something. Okay, I've created a list here for myself, ETFs to remove from standard searches. And what that is a combination of leveraged ETFs and inverse ETFs. See, I'm still bullish here, right? I don't want to see a bear 2 times or 3 times ETF, because if the stock continues up, if I'm bullish and the market continues up, those go down. I lose money. So actually, I'm just going to remove the inverse ETFs, right? Too many, 169, but that's fine. S&P, EFA, IEV, DIA. Ooh, that's always a fun one to see. SPY, XLV, XRT, retail there. But see, look at the risks. I'm going 2, 3 strikes in the money. Highest risk on page 1 is 2.6%. SPY, 290, 199. Buying the 175-day out March 300 only carries a risk of 1.5%. It's volatility. Also means it's harder to make a profit on because in general, it moves more slowly. All right? I took out the inverse so I don't see those, but there might be those with the higher risk. Okay, here, instead of sorting it by risk, if I sort it by net debit, I should have the 2 or 3x on the tops. Oh, wow, I don't have any. That's impressive. That is impressive. I thought I'd have some 2 times, 3 times in the 5, 6, 7% risk range there, the net debit cost range. I'm sorry, I should have done that differently. My apologies. Let's keep it at risk. Let's change it from greatest to lowest instead of lowest to highest. Okay, there we go. All right. So yeah, we're in the 7, 6% risk with some of the obscure ETFs there as well. That's okay. So there you go. Drop the risk level out because you're going to see 1, 2, 3% risk, but just keep it to 8. Keep this here. Keep your time frame here. Take out volatility. Those all probably have volatility of stock volatility of probably less than 0.2. Take out the earnings per share growth. Change the list to index and ETFs, and you might want to remove counter market. That should get you all set. 169 results, as you can see today. All right, let's get to Mike. All right, because he's been patient. And he has some comments to make too, but okay. So Mike S. says, hi, your level is well above my understanding. Well, this is what I do for a living. What your job was, if you're still working, if you haven't retired, you're going to be well above my head in what you do. Sometimes I do talk too fast to answer the questions directly without giving backgrounds, and I know it can get lost sometimes, but let's take that. You say, I appreciate whatever I can learn. I have a simple but painful question. Several years ago, Google ran up sharply to 600. You were told through a subscription service that it would be good to sell or take the reverse position in Google. So you did, and I've been sitting on the Google short for the past several years paying 2 different interests, and my losses are so great that I freeze up thinking about buying back at this level. What do you think I should do? Okay. I cannot give you any direct advice on a particular stock, a particular strategy, or so forth. I'm not even going to fathom where your losses are right now. Okay. They said short Google at 600. Never use that service again. Okay. It's just what I'm going to say. Oh, I'm sorry. I put it in the wrong position there. There we go. All right. Well, you got a 1% drop today. That's something. I'm sorry. I'm trying not to make light of the situation, Mike. Okay. So why did I come here? I'm going to see what the current chart looks like. If I saw the chart today, I haven't been following it. I'd say that if this next wave continues, see, it's bounced off its lower Bollinger Band 1175. It's moving back up to the 20-day moving average. Does not have a MACD crossover yet, but it's getting closer to it. If on Monday or Tuesday I see a positive MACD crossover, this starts to turn here, I'd expect it to go back up into this level within the next 30 to 60 days. All right, that's a short term. If I see that, okay, if that does happen. I'm not saying it will, but if that does happen, I expect it to go maybe back up to the 1200, 1220 range. If there's a MACD crossover, the RSI continues back up. The amount of the loss you have, I can't give you financial advice as to, oh, you should just close it and move on. Okay, I'll never say that. I'll never say that online. You have to decide what's best for you in that realm. What you may be able to do, something to consider, and I don't know where your knowledge level is you may consider doing straddles or strangles, long straddles or long strangles, shorter term or a couple months out on this position. You know, buy a call and buy a put, which will be expensive, same strike or different strikes. And as the stock swings up and down, try to maneuver that to profit on the options to help cut into some of the loss. But you've eventually got to set yourself a top. I'm not saying I think Google could go to 1,400 or 1,500. You've got to set yourself a top, though, because the amount of time that you say you had money tied up into this because you didn't want to take the loss with the margin and then the interest and margin to cover some of the huge amount of loss you have here. Think about all the other positions going the other direction that could have been used in the past 2 years or 3 years alone. I mean, you may have to consider at some point, I'm not saying now, I'm not giving direct advice, but you may have to consider at some point getting out and taking the loss. I can't imagine a scenario short of a black swan event or anything like that, or something comes out just of complete, what's the term I'm looking for? Not patent, but, you know, the complete, not insider trading, but you know what I'm saying, you know, patents that they stole essentially everyone else's patents to create all of their computer technology and lied about it. Something very drastic would have to happen. Selling secrets to all governments with their algorithms. Something extreme. Not a poor earnings. No, that's not going to do it. You're not going to get a 50%, 40%, or 100% drop. Well, not 100, but, you know, 50 or 40 or 30% drop, maybe 25, maybe 20 from poor earnings. Okay, you're not going to get that. It's going to have to be something drastic that you don't know is coming. They could get this back to the level where it makes sense to maybe buy back for you. So in the shorter term, I try to make back some of the loss, maybe trading different option strategies inside of it, but you have to be careful. because you don't want to be putting too much money into that scenario and risking larger losses, okay? Okay. Okay. All right. Oh, Larry, okay, so Larry's making a comment. He says, nobody knows, nobody knows, yeah. He says, I think it's something that a lot of us are interested in. There might be some doing leaps that are interested in and going forward there. And I've commented on this a couple times in that situation there, Larry, when you said, you've heard someone talking about it. I forget the name, but I've seen it mentioned here. There's a couple webinars I've done in the past month and a half, and I think you were on one or two of those, where someone came in and said that I'm interested in doing the long-term in-the-money leap diagonal calendar spread because it's the poor man's covered call. Okay, let's take a look at Carnival. Carnival's trading at 67. I could buy a January 55 call, 12 points in the money, about 4 full strikes in the money at 14.30, and sell a 1 month 70 call. That would make the most sense. 67.50 would be close here. 60 call against it. And you have potential for a higher return. And why is the return so high in the first cycles? Because the expectation of losing time value on this option is very low, because it's deep in the money and it's out to 2020. Stock's at 67, drops 10% to 60 in the first cycle. And this would have cost us $14.30. Value goes down to 1067. You keep the credit, but it's a loss of $303 against a $14 investment. What is that, 25%? A little less, okay, 21%. You're at a 21% loss, okay? And if in the first right cycle you're only making 2 or 3%, this is 35, it's a bit exaggerated, I think. But anyway, if the first right cycle you're making 10%, this one would have wiped out 3 or 4 trades. Yes, you're going to continue to trade it, but now it's continuing down. You're risking going to 30% loss. You have a 30% loss, a 33% loss. You need a 50% gain on what you have left to get back to break even, okay? And so forth. Why am I saying that this isn't really the poor man's covered call? Well, if I bought the stock at 67 and it fell 10 points in that situation, I'm losing $7. It's 10%. Here I'm only losing 300, but it's 21%. Calling it the poor man's covered call is risky, because a lot of times you can try to go deeper in the money for the delta of 1, but then the profit makes no sense. Okay? The only way to do poor man's covered call to get a lower cost is if your in-the-money call option has a delta of 1 or 0.99. And if you entered a calendar spread with a delta of 1 or 0.99, maybe at the 50, it's going to cost you $18, $19, $20, and you're getting 60 cents back for the first cycle. This profit's only going to be up here at $15, $50, $45. Yes, you're planning on writing it more and more, but that's not how it works out, okay? Trick of the thing is, too, is to remember, we talked about this, is that remember, we want a delta ratio that's, when we open a position, of maybe greater than 1.8 or 1.6, so that the long option gets higher. And in that case, what we'd look for, in that case, what you're going to look for is that when you get to expiration, remember the secret that happens. I started with a delta ratio of 1.8 where the delta of my long was much higher than my short. But at October expiration, the delta of my short is doing one or two things. It's either going to 0 or going to 1. And if this delta is still at 0.8, even though it's in the money, deeper in the money, I have a negative delta ratio effect now. I'm losing more on the short call than I'm gaining on the long because I'm at expiration. And whatever the stock does is a 1-to-1 gain on the short. I'm not gaining 1-to-1 on the long. All right, so this is why I don't like rephrasing it as a poor man's covered call, because the lie of leverage, sure, it's less monetarily, that looks great, but remember, it's 21, 22, 24%, whereas the stock's still down 8%, 9%, or 10%. That's why I don't like calling it a poor man's covered call because it assumes, hey, the stock fell 10%, I'm not worried about it. You better start worrying about it at that point. Okay, even if you've got years to go, 250, 60 days, I'm sorry, 250, 360, 400 days to go. If there's a position in your portfolio that's down 30, 40%, you should start thinking about that very, very quickly, even though you have multiple times, multiple months to go. Okay, all right. Okay. Okay, so sorry, let me just get off of that. That was a... All right, Mark says, what does risk mean on the search screener? What am I in? Oh, I'm in diagonal, so that's not it. So you're talking about married puts? What risk is what's the most you can lose on the position, right? There's two factors here. Monetary risk. This is a married put, remember, Mark. I'm buying a stock and buying a put, so I know exactly in the worst case scenario, if the stock went to zero, I can only lose $1.12 on this at-core international position. That's the monetary at risk, the max risk monetary. The percentage at risk, that 112 only represents 3.6%. Oh, sorry, 3.6%. My total investment of 3112. Okay, so that's my monetary and my max. So the married put is that protective structure. No, sorry, folks. That protected structure that even if the stock fell to $15, got cut in half, fell to $13, I can't lose more than the maximum risk. Okay, that's what risk means on the screener. You'll see it in collars, married puts, married calls, short collars. It's the most you can lose on the position. And Mark, you had a comment to Mike following up. He says you could gradually ease out, sell puts to potentially get put or receive Google stock. Well, yeah, we've got so much money tied up in the margin, then there's a problem. Okay. Okay, Fernando, we talked earlier this week, had a great conversation. I've got some ideas for blog articles and other things for Fusion and Blueprint members only based on our conversation. Fernando throws out there, should be a good idea to pyramid a married put structure, adding stock to relative put protection in an uptrend environment. I would rather do income methods that help me get more profit out of it than put more capital into a protected structure, okay? All right, that's what I would consider there. So Ali is the one, the married put I'm in right now. Ali's the one that's doing the best for me. It's a 14% return right now. That's not what I wanted. I wanted the chart itself. OLLI. Goose should be my biggest return, but I capped the gains when I shouldn't have, when it ran up from 36 up to 62, and it's back down at 56 now. But yeah, here's where we are. Cost base got in around here, I think, maybe over here, and rolled the put up a couple times. So here we are today. What would never enter my mind going in a continued uptrend here is necessarily laddering the married put, getting out of my existing positions and going into this. It would have been profitable, don't get me wrong, Fernando, you're absolutely right. But why not do something that gives me more benefit to the upside? Income method number 5, the bull call debit, where I get a little bit more kick between the strike prices as it moves up. We sort of looked at that at the beginning. Maybe just even buying a call inside the married put position. In your blueprint, Fernando, remember in that chapter for income method number 4, there's an alternative to income method number 4 where maybe you close out of the married put and use the profits to just buy calls going forward. That's something I could have done today, okay, rather than rolling up the short call from 92 to 95, which I did today. I could have let it be assigned, sold to close the put, and then just use the profits from the position to buy 3 or 4 calls, the 90 or 95 strike, if I'm still bullish on it, and done it that way. Only do that when you have the profits and the calls you buy are no risk, bulletproof. Okay, so that's what I would look at. Oh, so Mike says, I apologize, I did not clearly hear the other gentleman's suggestions. Is it possible to repeat? Yes. What Mark was saying, Mike S., is that on Google, do I still have it up there? I think I took it off, but on Google, he's saying sell put options, maybe cash secured puts, or maybe even do bull put credit spreads to alleviate the cost, the margin cost, the leverage that you'd have using a cash secured put on Google. And so what does a put do for us? Well, if I sell a put, let's see, with the stock at 1172 right now, let's say I sell an 1160 put 2 to 3 weeks out. Now what does that do? That obligates me to potentially buy 100 shares of stock at 1162 if the stock falls below that price. If it stays above, the put expires worthless and I keep the net credit. Okay. However, I should have just gone back to the custom spreads. If I sell a few of those naked puts at the 1160 level a couple weeks out in time, let's just sell one, okay, to be what's called totally cash secured. So I don't own anything right now. I'm selling a put against the position. If you're short several shares of stock and you're selling a put, it'd be considered a covered put, but the loss in your case would still be extremely high based on the numbers. But here's a naked put position. If the stock stays above 1160, the puts expire worthless and I keep the net credit. But you can't do this for free. If your broker requires you to be cash secured, you'd have to put up the full $116,000 that you would need to buy 100 shares of stock of the strike. Now you're getting $1,225, but you'd have to put up $116,000 to do it. If they allow you to do it on margin, you only have to put up $58,000. But then if it does fall quickly and you get put at 1160, you've got to cover the remainder or be in a margin on the long side instead of the short. But what he was suggesting is that if you do this and you have the capital and then you get put stock at a lower price, 1150, 1147, if it does drop to those levels, you could maybe use that to cover some of the losses that you have on the short position because your put stock, your broker would probably just cancel it out because you can't be long and short at the same time. It's a little tough to consider, but that's what he was referring to, selling naked puts. Now what I said is to free up the margin is instead of just selling that 1160 put because it's so high, if I did a 5-point spread, I'm not going to get as much capital, a premium, I'm not going to get as much credit here. I'm going to get $12.25 for selling. I've got to pay $10.60. So we're making about $165. 10 contracts would be $1,165. But I only have to cover the 5-point difference between the strikes. So again, if the stock falls to 1159, that put expires worthless. I may be forced to buy shares of stock at this price, but I'd use that to cover my short at the much lower level. I don't know if that's necessarily a great idea to do, but it is an idea. Okay, that is an idea in that situation. Okay. Okay, so what was next? Isaac was next. He said, Michael, I emailed you a question about leap calendar spread using SPY. Buy 2020 June and sell weekly in the money put. I can't remember if we talked about that over email earlier this week. Oh, 1 second here. Screen should be paused. Just give me 1 second. I'm just going to pull something up here real quick. All right, so there we go. Let's just do this. Sorry. Okay. So I have to get into the email. I don't leave it open while we're on the webinars because when a new message comes in, it pops something up there as well. Why am I doing this in the background? Because okay. I got to move this over here. I'm sorry. I've got my email. Isaac, you meant that you sent me an email on 9/17. Okay, you're referring to an email that you sent on 9/16 or 9/17. I sent you a response at 5:33 p.m. on September 17th. I'm reading it there on my other screen. That's why I was logging on to the thing there and I was pulling it up. Your original question was, I was trying out a diagonal put strategy as a hedge. I bought an SPY 290 expiring in September. Okay. I guess you didn't see my response, Isaac, but I did respond to your email, and I'm going to read it out loud to everyone here. SPY 290 expiring in September 19. Okay. Don't know the prices, but you bought a put here. It's at the money now, out of the money now, okay? To reduce the cost of this hedge, I sold a September 21/18 today. 288. There we go. Okay, I was planning to repeat this every week. I had a slight bearish view when I put on this trade. I hope the short put premium will decay fast and I'll be able to make some gain. Okay, so let me just build this here. I'm going to put the current price in for this, and we're going to sell this at probably, I don't know, let's call it just 97 cents. Okay. All right, so there's the calendar put. Yours looked a little bit better. I think we're exaggerating the cost of this long here with that at 291. Maybe it was a little bit higher before, so let's call it 1001. Okay. That's a little bit better calendar put. Okay. Probably too good. Let's go back to let's go back to 14. Anyway, all right, so we've got this calendar put in place. Now, you're selling the put when it was slightly in the money. You're planning to repeat this every week because you had a bearish view. I hope the short premium will decay fast and I'll be able to get some gain. I expected the short put would close slightly above 288. Yeah, okay, respectively. So there, the long put will gain. And the short, yes, you had the drop, but then it pulled back up at slightly above 288. It didn't drop as far as you wanted. I'm sorry. The long put will gain more than the short put because of the higher delta and smaller time decay. Now, you sent this to me on the 17th. Today, when the market started going down, the beginning of the week, the short put acted weird. It was gaining value faster than the long put, and the loss was increasing rapidly. I did close out the short put. Now I'm left the long put, which is gaining offers protection if the market goes down further. Okay? And he said, I'm not sure if this strategy will work if the short put is sold ATM, OTM, or ITM, depending on short-term outlook. Okay, now, here is my answer. This is what's defined, what I said in my response. I don't know why you didn't get it, Isaac, but it said, what you've described is sort of a classic gotcha for calendar spread investors. Diagonal calls, diagonal puts, horizontal calls, horizontal puts. Don't worry, these things get me as well. Now, when I saw your question about the short reacting weird, I initially thought that it was one of two things. Without looking at anything else, it was one of two things, okay? Now, whenever I set up a diagonal call or put, I look for a long option that's in the money, which you did, and a short option which is at or out of the money at the time. So you've got an in the money, you had an in the money put, and you're really close here. It's almost a horizontal. Okay, I probably would have bought the 300 and maybe sold the 290, whatever. Okay, but your structure is okay, it's just a little close. But I usually look for a delta ratio of greater than 1.7 if I'm using different strikes, meaning the delta of the long had to be 0.7 higher than the short. Delta of the long divided by the short has to be a ratio of greater than 1.7. Okay. And in general, I don't want the short option delta to be lower than 0.40. I want it to be just out of the money or more when I open it. Okay. Now, here's a trick. Both options are out of the money, which is different. But at the time when you wrote me, we were down to 289, so it was getting close to the 288, but the 290 was in the money. Okay, but what happens as you get to expiration, we just talked about this. What happens when we get closer to expiration of the short option, the delta is getting closer to an end value. The delta of your short option is getting to an end value that's either going to be 0 or 1. The gamma, the delta, they're both forcing themselves to try to be closer to 1 or 0 if it's out of the money or in the money. If it's bouncing between on the last day of expiration, I think we talked about this a couple weeks ago with Paul, on the last day of expiration, if your option is going from in the money to out of the money, you're watching the delta shift from 0.75 to 0.25 with a 10-cent move. Doesn't make sense, but if you sold the 50 strike and you're at 50.10, with an hour to go to expiration, you're at a delta of probably 65 or 70. If it drops down to 49.90, you're at a delta of 0.2 to 0.1. And so that the gamma is getting closer to 1.2, and it's ridiculous. So the stock is going to move as you get closer to the short option expiration date, 4 days away. The short option delta is getting closer to that end value. This means the delta is getting closer to 0 for all out of the money and closer to 1 for all in the money. In a few days, it's going to be 1 or 0. Okay, once it goes in the money, it's only, once it goes in the money, only a few days left to expiration, the delta will increase. Meanwhile, your farther out 290 option is hovering at around a delta at the money of about 0.5. All right, so when this started to get in the money, this is reacting much faster, going to a delta of 1, 0.8, 0.7, where this is staying at 0.5 because it's getting closer to in the money when it was at 289. Maybe the 290 was at 0.55, 0.6. But this is bouncing between closer to 1 and closer to 0. Okay, that farther option always reacts more slowly as there's still several months to expiration. The gamma changes, which fluctuate the delta on the short option once it goes in the money, will be closer to 1 as well, also severe. So on or near expiration, if my short option is slightly in the money or it's getting closer to in the money, that delta is getting forced to 1, but it could suddenly just go to 0. This option is still hanging out at a delta of 0.5 or 0.6. That's why, one of the reasons why. Now, this was part of the problem. The other part of the problem was that on Friday, close of Friday, the 14th, your short put, the 288, had a delta of 0.2, negative 0.2. With that $1.50 move today, the delta went up to 0.34 and then up to 0.45 at one point. That's a change of 14 and 25 delta on the short option, your obligation. The change in the delta of the 290 put from Friday's close last week to Monday's close when it was down 154, or in the middle of the day when it was down 154, only moved from 0.44 to 0.45, a gain of 0.01 in your favor. This is due to this option is always going to react faster. As you get closer to expiration, that delta is going to be pushed to 1. And if it stays out of the money, it'll suddenly go to 0, and this might have only gained 0.01 or 0.02. Issue with the poor man's covered call we talked about in the long-term diagonal spread. The leap lags. You might see a 2% movement in your stock on one day, 2 days to expiration on your short, 450 days on the long. The long option delta might only move from 0.44 to 0.45, or if it's in the money, it might move from 0.55 to 0.57, 0.6 to 0.63. Your short option delta might have just jumped, the one that's against you now, it might have jumped, you're slightly out of the money from 0.4, now it's slightly in the money, it might have gone from 0.4 to 0.6, a change of 20 where you only got 0.01 change on the long-term option. Okay, now, all that being said, my second part of the email was the second issue, and it appears to be the one that hurt your short position the most, is or was implied volatility. Typically, I look to open positions where the short option implied volatility is higher than the long, an IV ratio of greater than 1. I want that decay to work faster in my favor on the short than comes out of the long. You might have done that, but on Friday, oh, sorry, wrong field. On Friday, September 14th, oh yeah, I'm in puts only, and we were 21st expiration, right? Or was it the 19th? Oh, it was the 21st. Okay, but in any case, on Friday's close, the IV for the 2018 21 September 288 put was, on my notes, 0.1048, 1058. Oh man, it's just too many strikes. There we go. That's the implied volatility, 0.1058. Okay, with the $1.54 drop in SPY, which forced this at the time out of the money option to near at the money option. Am I still in the, no, I went to the 24th. Hold on. Okay, but with that $1.54 drop on Monday and the SPY, the implied volatility of the 288 short put for the 21st was 0.1565. $1.27, $1.30, 0.1565. Now that may seem like a low IV. Doesn't seem like a big move. 15% implied volatility is low, 10% is low. Keep in mind, from Friday's close to Monday when you email me, that's a gain of 50% in implied volatility. You went from 0.10 to 0.15. Okay? This caused the increase in price drastically. Okay? So with the delta that we had on Friday, this change of $1.34 on Monday should have only increased your option premium by 31 cents, about 20 cents for every dollar SPY fell. But the option doubled in price from 62 cents to 128. Why was there an additional 32 cent increase to 127 on Monday? Because the IV went up by 50% as well. And although it doesn't seem a high IV at 0.1565, it was 0.1058. So it went up 50% and that 30 cents for the 20 delta that you had. Right? So you moved down $1.54, 20 cents for the first dollar against you, 15 cents for the next one. Okay, so that's what the additional was. It was an increase of 50% IV, and it was because it naturally would have moved up 30 cents from the delta alone with a $1.54 move. Now, although your delta on your far out option was different, it was higher, the far out option is not subject to these near-term fluctuations in volatility. In fact, on Friday, September 2019, on Friday, your 2019 290 put was at about $14.96 with a delta of 0.44 at an implied volatility of 0.14. On Monday, I said today, but on Monday, I can't show you the email because I've got other emails in there and I can't show customers' names and things of that nature. But anyway, I'm reading it from the email I sent you on the 17th. Today, the 2019 290 put is priced at $15.32. That was the midpoint, so it only gained about 40 cents, 36 cents. About half of the gain that the short 288 put in September this month moved against you. Okay. The IV on the 290 put that's a year out in time from Friday to Monday. On Friday it was 0.1416. On Monday it was 0.1392. It dropped. The implied volatility on the long option dropped even though the implied volatility in the near term went up 50%. Okay, so it's not a big drop, but it's not the 50% increase on the short. And because the short is affected by the shorter term movements in the stock, the long is not. It's going to lag. A leap is always going to lag, okay, before you see it. Those two factors, but mainly the change in IV, but also the reaction of the delta in this case, how it moved from 0.2 to 0.34, a 14, 15 point move in the delta when you only got a 0.01 movement on your long leap delta because it lags, and the volatility actually dropped on the leap option where it went up 50% in the short term. That's why your 288 put for 5 days away jumped up 60 cents instead of the 30 cents you were expecting, and you only gained 30 cents on the long put that you have further out in time. Calendar spreads, diagonal spreads, horizontal spreads always get tricky within 3 to 5 days of that short-term expiration, especially the last 2 days, because that short option is either going to go to a delta of 0 or a delta of 1. It's going to react very quickly to the movements of the stock, where your long option that's 300, 400, 500 days out in time, 260 days out in time is not reacting as quickly. It doesn't go to a delta of 1 yet. Fernando, we've talked about this on other presentations. What do you do in the poor man structure if you were signed on the sold call? Well, you either buy the stock to cover the short, okay, exercise your long to deliver the short-term obligation. Pray that it wasn't done on ex-dividend date, that you were paying attention, because if you get assigned on ex-dividend date, you've now got to pay the dividend because you're short the stock. If you don't have the money to be assigned and be short the stock, this isn't a call, not a put. If I'm in a calendar call and I get assigned early on the short, I'm now short stock. If I don't have the money to cover the full, my broker would likely exercise the long to deliver the short, which means I'll get less return. You want to try to avoid exercising your long to deliver the short-term obligation if at all possible. Because if I'm out to January and I get assigned and then my broker takes the 290, I get my 2 points back, this still probably has $8 or $9 of time value remaining. If I'm exercised to deliver my short, that's gone. I don't get that $8 of time value. It's gone. So in managing a diagonal spread, you always want to make sure you keep yourself in a position where you can sell to close the long. If you're at risk of getting assigned early, you might want to roll it. You might want to buy a short-term call to create a short-term bull call debit spread, leaving the leap open in that situation. I'm sorry. Mark follows up on that. He says, your rules of thumb on diagonals, delta 0.4 on the short, that's not a rule of thumb. That webinar I pointed to last week where it discusses the criteria for the diagonal spreads, free webinars, option strategies, calendar spread criteria, I discuss it there in the diagonal discussion and what's sort of shown here. I did mention, Mark, in my conversation just now that my short option delta is usually around 0.4. Why? Because I'm going out of the money slightly. Okay, I don't want to go too far out of the money. I want to keep this usually unbound of 5% out of the money or less for the best premiums. I don't want to go too deep out of the money on that short. So yeah, here's stock at 45.80. I'm selling the 48 for 90 cents. 10-point spread, buying a 38 for 9.50. It's because I want to be out of the money on the short, so my delta is usually around 0.4, but I want my delta ratio. In this case, I'm keeping it at 2. I want it to be double. But anything greater than 1.8 is the ratio I'm looking for. Delta of the long divided by delta of the short. Okay, so it'd have to be 0.4 to match, wouldn't it? If it came up in my search, I'm looking for a minimum of 0.8. My short option deltas are going to be between 0.4 and 0.5. I don't mean less than 0.4. I don't mean they're exactly 0.4. I'm shooting as an average because that's where I usually look with my settings. I should have saved that here and I didn't, and I usually don't want to go more than 10, but let me just go ahead here. No, I'm going to open that up. I'm going to go 15. It's a guideline, but it's not a rule, especially if I don't have as many results as I want. I want a good list about 15 to 20. Good list, 15 to 20. Okay. So here again, Norwegian at 57.88. I'm selling the October 60 call for 50 and the December 50 for 8.80. 10-point spread, maybe a little bit wider than I'd like. Here's one on Newfield, 29.03, selling 30, buying the 25. That looks pretty decent numerically. Haven't looked at the stock yet. Let's take Norwegian. Let me go to research, Mark. Short call research. Delta of 0.34. That one's a little bit less, and that's okay. It still has the ratio that I wanted, but it's not greater than 0.4. It's not less than 0.4. It's just about an average because I'm going 1, 2, maybe 2.5 strikes, 3 strikes out of the money at the most, but usually around 2 strikes out of the money to match the criteria. So if this offered singles, we'd say 58, 59, and I'm at the 60. If it doesn't, it's just 1 strike out of the money. If it's just 57.5 and 60, I'm just 1 strike out of the money. That's fine. Delta of 0.3. This one might be a little bit higher, might be closer to 0.35, 0.37. 48.79 to 50, it's probably around 0.35 as well. I'm looking for a close one. COP 7628, the October 78, I'm going to say 0.38, 0.39. 0.33, I was way off. Okay, but it's in that range, so. Zaid, I can sum this up for you very quickly. Yeah, and it's for the diagonal screening. I understand, Mark, but I think that's why I don't focus on the short. I don't put a delta in on the short. If I'm looking for a minimum long option delta of, let's say, 0.7 or 0.8 or more, and I want that delta ratio of 0.2, this is already being taken care of for me. Okay, it's going to match whatever I want there in that scenario. Okay, so that's just the guideline that I use there. And that doesn't make a hell of a lot of sense, does it? Sorry, pardon my French. I shouldn't see these. Surprise note. Wow. I'm going to have to yell at a programmer about that. If I'm forcing my delta on my long call to be greater than 0.8 and I want a delta ratio of 2, I shouldn't be seeing anything that's 0.3 or 0.35. It has to be 0.4 or higher. I'm thinking of my normal screen, which is 1.8, in which that would be allowed. But this is 2. I should not be seeing those at all. I got to have a programmer look at that on Monday. Give them the weekend off without rabbling on them. So yeah, that's these ones here with 0.34 and 0.35. If my long delta is 0.8, they should not show up. One of those filters is currently off. Yeah, it's 0.88. It'd have to be at least 0.44. Oh, no, it's right. Everything's right. I'm wrong. I'm sorry. I'm wrong. I'm thinking short of, I'm sorry, folks. That was just complete reverse in my mind. I'm going backwards. Okay. All right. All right. So, yeah. Okay. So, Zaid, this is a topic I said I was going to answer here very, very quickly. And I'm not going to give you the answer you want because it's different for each structure. It kind of is. There are 5 rules of thumb I apply to any adjustment. Zaid's question, and it is an important question. It is a great question. Don't get me wrong. I can't answer it directly, but I can answer it this way. Zaid's great question is, I am having a hard time knowing when to manage my positions. Not positions. How do I know when to manage a position? And then my first response is, well, what position? And then I thought to myself, you know what? In most cases, it doesn't matter. Think about it this way. What's a good example for me to use? Bull put credits. I'm just going to go to the search real quick, Zaid, and I'm going to show you something. My default bull put weekly search that I use to find positions for a small portion of my account, ignore the option structure for the time being. Technical and fundamental criteria I look for. I want the stock to be above a 20-day moving average. I want the stock to have at least a 3-day cross MACD signal. I typically want the stock to reflect, I usually put in earnings of at least 5%, earnings per share growth of at least 5% or more. I don't really use RSI, but you could use that too. Okay, now what am I talking about here? On a stock chart, in this scenario, what I am talking about is the MACD lines here. I want a positive MACD cross for at least the last 3 days. Hopefully it's above this. It doesn't necessarily have to be, but hopefully it's above what's called the divergence line. I'd like to see an uptrending RSI, but not peaking out at 90. I'd like the stock to be above the 20-day moving average and moving in an uptrend. Okay? You might use stochastics. You feel comfortable using stochastics. You feel comfortable using Fibonacci scales. You feel comfortable using something else along those lines. Okay? What I look for when adjusting a trade, if I had bought this stock, wait, how did I just move from a bull put spread to buying a stock? It doesn't matter. If I'm buying stock, doing a covered call, cash secured naked put, bull put credit spread, married put, standard collar, diagonal call spread, bull call debit, buying a call will look a little bit more extreme. Any strategy that's considered neutral to bullish, I'm looking for those 3 same criteria and fundamental criteria of a good average stock volume, good earnings per share growth over the last year. Any stock you trade a bull put or a diagonal call spread on is a stock that you would not mind owning. Not because that's the outcome of potentially a put credit spread or a naked put, but because it's the same exact thing. You're neutral to bullish. You want the stock to stay the same or move up. So if I had bought this stock back in July or done a diagonal or done a married put, I would have likely closed the position right here or adjusted it. Okay, why? Stock dropped below the 20-day moving average, one of my filters. The MACD had a negative cross, so that's a confirmation. It dropped below the 20-day and we had a negative cross, so I'm going to exit the position. And this was started to decline as well. So right in this time frame here, after the second day is below the 20-day moving average, even though it looked like it wanted to creep back up, I probably would have closed here because signal 1, signal 2, signal 3, 3 red light confirmation. Okay? But if you use stochastics instead, use Fibonacci, same thing. If it reverses and you look at the strategy and you say, would I enter this strategy now with a negative MACD, a stock going below its 20-day moving average, dropping below the lower Bollinger Band, a negative RSI? No. Why stay in it? If I stayed in a long call, married put, bull put credit, collar, diagonal spread, at this point and to this point, at this point, if I stayed in it, I'm in trouble. Okay, I should have at least exited by here once the MACD and divergence went to 0 if I hadn't done it already 5-6 days before. Whatever you use to get into the position, technically, fundamentally on the stock, you should use that as an exit point if it reverses. Not necessarily an exit, but a point of adjustment. Okay? When to adjust a position. when to manage a position. Those are the first three things. If your technicals and fundamentals that you use to get into a position for a bullish stock reverse while you're in the trade, all three of them in my situation, you should consider that. Okay, you should consider adjusting or getting out at that point. Why did I say that I can't really answer your question? Okay, well, let's say that I use all the three same criteria I did, and the three criteria, MACD, Bollinger Bands, and SMA 20 are still okay. When would I look to manage this diagonal call? I sold a 60, bought a 50, and I'm hoping the stock goes up. Now, this would have been just intraday, so it's kind of a bad example. But see, in this situation, once the stock starts getting closer, now for me, for the options, once it starts getting closer to 50, remember, I only wanted to open the position if the delta of my long was 0.8 or greater, and my delta ratio was greater than 2.0. If the stock falls and this delta drops below, say, 0.75 or 0.7, I'll give myself a little bit leeway because stock fluctuates. But if it drops below that mark, I might consider managing the position. I might roll down the call to stay in it. I might roll down the short call to try to turn it into a horizontal to make more premium back if I think it's going to fall. But if my delta fell and the MACD is now negative and I'm below the 20-day moving average and RSI is declining, I might want to get out of this position or add a put to create sort of a calendar strangle with a short-term call against it. Okay. Oh, sorry. But on the same venue, if I'm in a bull put credit spread where I have sold the 57.50 and bought the 52.50 or the 55, whatever, if the stock reaches within 1% of that short put, which might obligate me to get the stock, I want to get out of this short put. See, now I'm taking if I see those three technicals that I mentioned, those three stock criteria go, that is a good trigger for me. How I can't answer the other part of it is because, well, if I'm in a diagonal spread, I might also look at the short option delta, the long option delta. On a bull put credit spread, I won't. I'll use the pivot point, the strike price of the short. On a covered call, I'm probably focusing on the break even because I'm planning on staying in the stock longer and continuing to sell against it. A bull put is more of a one and done, and a calendar, I need to keep rewriting it, but I don't want to ever write a short call below the long call because now I might as well just be in a calendar put instead of a calendar call because I'm bearish trying to repair a stock I was initially bullish on. It gets tricky at that point. Write out a trading plan, okay, for whatever strategy you're using, Zaid, whether it be covered calls, whether it be diagonals. Figure out what you think you need long-term for win-loss ratio, average wins on your winners, what you're going to limit your average losses to in that case. Figure out your plan for the stock. What do you use to indicate a bullish stock? What do you feel over the years or even the last few months? What indicators have pointed you to the best bullish stocks? Because if you see when they reverse, that means the stock goes bearish, then guess what? That should be your trigger. If you're in a bullish position and you see those technicals go bearish, you should get out or adjust. If you're bearish and you see those go bullish, get out or adjust. Okay? All right. Yeah, look, Isaac, I apologize. Look for that email again. I'll try to resend it. I was just breaking in right now before Isaac has to leave. I think there. Okay, if you want to understand selling short-term. But anyway, so Zaid, there's more to it than just when in general do you look for it. Well, it also has to match your trading plan so that you can limit the risks on leverage positions to a reasonable amount. And I mean under 50% of what you have in it. That's a reasonable amount to take on a bull put credit spread. If you haven't done so already, Zaid, on Wednesday I hosted a presentation, 8 ways to manage a bull put spread. The first 15 to 20 minutes of that talked about the trigger points only for the stock as I just reviewed, but you get better graphics in this presentation, as well as what I might use as option trigger points, probability, delta, or premium, for example, to adjust the bull put credit spread. The first part of that discussion on the stock technicals applies to any neutral or bullish strategy I use. Just as I kind of showed today, but you'll see better graphics and maybe a little bit better discussion in the first part of this. Just go to powerup.com/webinars.asp, click on option strategies, watch the first 10 or 15 minutes of 8 ways to manage a bull put credit spread where we talk about the trigger points. Okay. All right. So in addition to that, I'm sorry, I thought Isaac was leaving. I read the question, but comment before it. Okay. Yeah, we did record it. You'll be able to listen to it again. I'll make sure to try to send that email again to you, Isaac. You said, from what you understand, selling short-term weekly options is too risky. I don't know what you mean by risky and again, what strategy, okay? I have no problem doing a 4 or 5 day out bull put credit spread. The credit is lower, but the probability is higher because it's shorter term. I look for 2 week out bull put credit spreads because my testing showed that from 2017 into 2018, through all of 2018, from 2016 to middle of 2018, and going back from 2015 to 2017, that the positions that were 10 to 14 days out in time performed better long term than the same positions trying to sell them week by week by week. Why? You get a lower net credit, that's true. I don't mind doing it if I like the stock and the position. The problem I saw, and it wasn't a problem, some of them were still very profitable, it's just this always performed better. Why? Because of some of these, you see I'm getting a 17, 15, 14% return. Average was around 11 or 12% return. Now, if I take one loss, my average loss is around 50% of the max amount to lose, but if I take one loss, this only wipes out maybe 7 or 8, maybe 9 trades. Still don't like it, but that's the balance when you look for probabilities of 85, 80, 87, and more. Now, I take the same structure and I go short term instead of 14 days out. We'll see spreads, maybe 1 point spreads, that offer an 11, 12, 13% return. Okay, there they are. But you also see a lot of 2.5 point spreads that are at 23 cents. Now, that's not bad. That's still a 9.9% return. But 23 cents, see, they're all smaller. And a lot of times, if I ran this Monday, these would be down to 18, 19, 17, 15. Okay, so now you take one loss, you're maybe wiping out 22, 23, or 24 trades. So what I noticed that happens, whether I used 1 point spreads, 2 point spreads or more, less than 2 point spreads, with the same win-loss ratio, about 85 to 88% for 5 day out trades consistently over 2 years and 2 week out trades consistently, you had the same amount of losses, but the losses took out more winners because you're still taking a 2 point loss, a 1 point loss. You're wiping out 20 to 25 trades if you're trading every 5 days and you take a loss, as opposed to if you're trading every 2 weeks, you're only taking out 10, 8 previous gains. That's just the math with the net credit and the return. Now this one looks pretty high though. I like this 43 cents, but hey, we're on a 7.5 point spread. It's only 6% return. So 43 cents is good, but the margin requirement's wider. You take that 7.5 loss, yeah, you're going to wipe out 33 of these trades. So it's a gamble. It's a trade-off, but I don't think there's anything wrong per se with using weekly options in that instance. I just found that with the bull put debit spreads and the bear call credit spreads, that the 2 week out worked better long term as a trading plan. That's why we posted those results for the bull put weekly. And you said, number 2, Isaac, the indicators you use, aren't they lagging indicators? I didn't say use my indicators, Isaac, okay? I didn't say use my indicators. I use my indicators because that's what I'm comfortable with. I use the MACD, the Bollinger Band, SMA, because that's what I'm comfortable with. They've got me out of positions right on time, whether they're lagging or not. My emphasis on whatever you use to find a bullish position, stochastics, on option volume, ROI, Williams %R, Fibonacci, whatever you use. When you see that reverse, ask yourself a quick question. Oh, the stock went down today. Well, stocks fluctuate, it's down. My position isn't at too big of a loss right now. Let me look at the stock chart. Look at that stock chart brand new. Would you enter that same position looking at the stock chart where it is now with the indicators that you use? If your answer is no, consider adjusting or get out of that position. Okay? Zaid says, where can I educate myself on adjustments or exiting? Okay, I'm sorry. By default, I just kind of showed you. Free webinars, option strategies. Here's your 8 ways to manage a bull put spread. Okay, here's a full one on managing spread position, vertical spreads, bull call debit, bear call credit, and more. It's a lot of information, I know. Calendar spread criteria, there's discussion on calendar spread management and the requested topics. You can look up that. Managing your covered call positions, managing your bear call credit spread, managing your long options, buying calls, buying puts, managing if they work in your favor or out of your favor, managing your naked put positions. So right there, you've got 50 to 60, 70% of the main strategies that you'd manage. The requested topics, there is one in here somewhere where we talk about, I'll have to look it up for you instead of scrolling through in front of everyone's calendar spreads. Benefits and risks of calendar, diagonal spreads, diagonal horizontal. Maybe that's not the one we discussed. Oh, here it is, early assignment on diagonals. There's another one we covered today, a little bit on it, but there's a more of a discussion on managing the early assignment. I believe it was Fernando that asked that. Defining calendar spreads. I'll have to look for it. I keep a lot of the requested topics ones in here, but sometimes I call them out. I cut some of these out there and try to, some of them are similar, as you can tell in the Friday discussion, so I try to cut out similar ones after a month or so and leave the most recent one available. But go there, powerup.com, webinars.asp, public page, click on options strategies, a lot of information there in managing different positions. There's also some discussions here in requested topics. The reason I did that full webinar on Wednesday is on last Friday's discussion, it was a lot on bull puts and on management, and I said, you know what, I've got to redo that bull put management. I guess you guys are telling me now that I should redo the management webinar and calendar spreads, and for Blueprint and Fusion owners, I got to discuss income method number 5 and 6 again. That's no problem. So we'll get to all that in the next couple of weeks too. All right, so that's where you want to go to get some ideas, and then remember, you can send us an email or give us a call at any time. Isaac, I have to resend your email if you didn't get it. So you have that there. And then, of course, we can follow up our discussion on that also later as well. Okay. Well, I don't see any other questions come in, ladies and gentlemen. Oh, there we go. And we are essentially at closing time here, 6:17 p.m., 15 minutes after, 45 minutes after, but I expect these to usually go to 6 p.m. anyway. All right. So, again, if you haven't done so already, just remember, go to powerup.com at any time, put in your first name, last name, email address, start my trial now. You'll have full access to the 14-day free trial. Subscription levels after that start at $40 per month. We do offer 20-minute delayed service at $60. It's probably the most popular subscription. And of course, though, we do offer real-time and the historical service. We showed a taste of the back testing today. We ran 2 calendars back-to-back, going back 3 months. You have access to those historical tools for 3 months on the trial, but if you sign up for the historical service, which is 20-minute delayed, and the history, the historical data goes back to April of 2006. So you've got over 12 years of options data there for you to use. Other free stuff, hey, check out the blog at any time, blog.powerup.com. I'd mentioned a lot. We always do. The webinars page, you can go through that, see our different topics on management of different strategies, similar strategies. Trigger points are discussed in each one of those management techniques. They are subtly different, but remember, if you're in a bullish strategy, the criteria is almost the same for any bullish strategy that you'd use to look for a stock. And if that reverses, that might be a trigger point to consider adjusting or getting out of the trade. So yeah, we're having live webinars on Wednesdays and Thursday. Next week, Friday, of course, we'll be back here for the open discussion. You can always check us out on YouTube. And any further questions you think of this weekend later on, hey, send me an email to support@powerup.com. You can also reach us at support@radioactivetrading.com if you have questions about the blueprint. You can always call us during market hours. And again, any trial member subscriber can schedule one of those free coaching sessions. All right. Ladies and gentlemen, thank you again. Thank you for your great questions. Saeed, not trying to avoid your question. I know you didn't say that. I'm just trying to keep it in your mind there. I'm not trying to avoid your question. Is that the first step is to look at the trigger points of the stock, why you got into the position, why you selected to do this options trade under this stock. And if that stock reverses those trends, you should consider getting out of it, okay? Yes, there's subtle differences now when we get into the different strategies, but in general, whether you're bullish or bearish or neutral, if the sentiment has changed, if the criteria for the underlying stock that led you to this being a neutral, a bullish, or a bearish position have changed, then consider getting out of it before you get too hurt. The rest of it will point you in the right direction. Those webinars will help you, and then you can send us an email. We can get any clarifications you need with other ideas depending on the strategies you're doing. All right, well, ladies and gentlemen, thank you again for all of your great questions. That was a great question, don't get me wrong. I hope to see you all soon in the next few days for other webinars or other discussions. Have a great weekend. We'll see you soon. Good night.